Well, what did everybody think of Friday? That was a bloody day for sure, but a well-deserved bloody day. I had mentioned in previous videos that it appears that the market is openly fighting the Fed. A mantra that they've repeated before not to do. Don't fight the Fed. Don't fight the Fed. And since the train wreck of a press conference that Powell gave after the last Fed decision, you've had almost every Fed speaker say, this is fantasy. If you think we're just going to raise rates for a short period of time, we're going to end in December, say that's enough by March or April, and start heading back to the zero line. If you think that is pure fantasy. Market just kept chanting, we don't believe you, all the way to Thursday before Powell's speech, and decided that Thursday, the night before, was a good time to taunt the Fed by having an over 50-point rally on the S&P going into the close on Thursday night. Calling them out to the parking lot. Come on, buddy, what you got? Well, on Thursday morning, he came out, and in 8.5 minutes, he bloodied enough noses, I think, to make his point. Here's his speech, 4.5 pages long. That is it. So I've highlighted some points that are consistent with everything in the minutes, but really stress the point. I think when he wrote this, he kept trying to make it shorter and shorter. No extra words. Nothing for the market to grab onto and say, aha, look what he said over here. Everybody, come over here. Look at this sliver of light. Let's all crowd through here. There is no sliver of light in this speech. It is a veil of darkness. So let's see what he had to say. Overarching focus right now is to bring inflation back down to our 2% goal. Restoring price stability will take some time and requires using our tools forcefully. He wrote this. He chose these words. He chose the word forcefully. You have to think about, when you read the words, that there's a thought in the person's head that makes them put these words on the page. So you do have to read the words and try to put yourself in the mindset of what would make you write that word. What are you thinking when you write the word forcefully, right? Reducing inflation is likely to require a sustained period of below-trend growth. There will very likely be some softening of labor market conditions. With higher interest rates, slower growth, softer labor market conditions will bring down inflation. They will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. So he's saying, yeah, I got eyes. I can see the reports. I can see that growth is slowing down. I know that some people are going to lose their job with higher rates. You don't have to tell me that. I know it's going to cause some people pain. Tough. That's the way it's going to be. Tough. Suck it up. I mean, that is a forceful paragraph right there. He acknowledges, yeah, we know. You think this is something we don't know? We know this. So stop loosening financial conditions every time you get a report that says, oh, the economy's softening. We're not budging. In my view, our economy continues to show strong underlying momentum. In this first sentence, he acknowledges, yeah, there clearly some slowing from 2021. Tough. I don't see it that way. The economy continues to show underlying momentum. Labor market is particularly strong. Clearly out of balance. Not out of balance, clearly out of balance. For him, there's no question, it's out of balance, with demand for workers substantially exceeding the supply. Inflation is running well above 2%, and high inflation has continued to spread through the economy. A single month's improvement falls far short of what the committee will need to see. Now you may say, oh, but we've had 2 reports for the same month. We had CPI for July. PCE usually runs below CPI. We expected PCE to reflect July CPI, and it did. Those are not 2 data points. That's 1 data point for the same month, July. Since then, wheat prices have gone up. Copper has gone up. I believe corn has gone up. Wheat has gone up a little. Soy has gone up, and corn has gone up as well. Natural gas. RBOB Bob's having a hard time, but oil has gone up. Heating oil is going up. So we see these input costs starting to rise again. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. With inflation running far above 2% and the labor market extremely tight, estimates of longer run neutral are no place to stop or pause. So I didn't read the middle part here, but he at the last press conference said, with this rate, we are at our longer term neutral rate, or in and around the neighborhood of a longer term neutral rate. So the market interpreted that to be, you're signaling that you're slowing down. So he acknowledges that he said that at our most recent meeting. The FOMC raised the target rate to 2.25 to 2.5, which is in the Summary of Economic Projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, blah, 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 estimates of longer run neutral are not a place to stop or pause. I said then another unusually large increase could be appropriate at our next meeting. And here he repeats this troubling sentence again, but let's make sure we know what he's saying here. At some point, as the stance of monetary policy tightens further, it will likely become appropriate to slow the pace of increases. He's not saying it would become appropriate to stop. He's not saying it would become appropriate to reverse. He's saying to slow the pace of increases. So we'll still have increases, but he's going to slow it down. And last week I said, well, yeah, no one expects that you're going to raise it by 75 basis points forever. At some point, you're going to slow it down. Duh, but he said it again. And when I was listening to it, as he said it, I said, don't say that again. But he said it, and I thought, well, that's all the market needs. You gave them a toehold. That's all they need, and off we go. But he continued. Restoring price stability will likely require maintaining a restrictive policy stance for some time. So he's repeated the line, pace of increases that will slow the pace of increases, and then followed it up with, hey, before you start thinking about pivot, here's a sentence, for some time. The historical record cautions strongly against prematurely loosening policy. We're drawing on three important lessons. The central bank can and should, the italics are his, not mine, can and should take responsibility for delivering low and stable inflation. Our responsibility to deliver price stability is unconditional, meaning that it would be different if he said something like, we're going to deliver price stability conditional upon a strong economy. He's not saying that. He's saying it is unconditional. There are no conditions here, period. In my view, that the current inflation in the United States is the product of strong demand and constrained supply, and that the Fed's tools work principally on aggregate demand. None of this diminishes the Federal Reserve's responsibility to carry out our assigned task of achieving price stability. There's clearly a job to do in moderating demand to better align supply. We are committed to doing this job. So he is acknowledging the conversation out there that, hey, some of this inflation is supply driven and the Fed's tools don't work on supply. Hopefully they'll recognize that and they won't go too far. He recognizes that. None of this diminishes the Federal Reserve's responsibility, tripping over my words here, responsibility to carry out our assigned task. None of this diminishes our responsibility. Second lesson about public expectations about future inflation. Longer-term inflation expectations appear to remain well anchored. So there is a positive statement. It appears to be well anchored. Doesn't seem to be a problem. That is not grounds for complacency. If the public expects that inflation will remain low and stable over time, then absent major shocks, it likely will. And in support of expectations, he's quoting something called rational inattention. And this is saying that when inflation is high, people pay attention to it. But when it's not, it is rational to ignore it. That's what rational inattention means. He wants to get to a point of rational inattention. And he quotes Alan Greenspan here. For all practical purposes, price stability means that expected changes in the average price level are small enough and gradual enough that they do not materially enter businesses and households' financial decisions. That's the rational inattention part. And he says inflation has just about everyone's attention right now. So while inflation expectations remain well anchored, we do not have rational inattention, we have rational attention, which is a precursor to changing expectations. Inflation has just about everybody's attention right now, which highlights a particular risk today. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. Third lesson, and this is how he ends the speech. I mean, that's it right there, and I think he ends it on just the right note, the most powerful of the three. We must keep at it until the job is done. History shows that the employment costs of bringing down inflation are likely to increase with delay as high inflation becomes more entrenched in wage and price setting. The successful Volcker disinflation in the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. A lengthy period of very restrictive monetary policy was ultimately needed to stem the high inflation and start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve. He's basically saying, you want to compare me with Arthur Burns? Okay. I'm going to show you that I won't be, or I'll tell you that I won't be. Our aim is to avoid that outcome. The outcome of having a lengthy period of restrictive monetary policy, of putting Volcker into the position where he had to do that. So he's saying, I'm aware of Arthur Burns. I know what you're calling me. Not going to happen. Our aim is to avoid that outcome by acting now with resolve. We will keep at it until we are confident the job is done, period. Mic drop, and he walked off the stage. When he finished, I kept saying in my head, don't take questions, don't take questions. Don't deviate from what you just said. Don't take questions. Leave the room. Leave the room. And he did. It was beautiful. It was perfect. When we think of the type of Fed chairman he needs to be, we've always been using Burns and Volcker because, well, is he going to be like Arthur Burns and pivot, or is he going to be like Volcker and crush inflation? He needs to be more like Alan Greenspan. Greenspan never said anything. He didn't have press conferences, because he understood that the market would anticipate the next move, and if he felt he was near the end of a tightening cycle, that he still needed to tighten, but he was at the end, he knew the market would work against him, because the market would project out past that and start to work against him. So he didn't say a word. He didn't have press conferences. That never happened. You didn't know what he was going to do. He needs to be more like that. I would like to see at this point the Fed cancel the press conference after the FOMC meeting. Make their announcement, release their statement, and be done with it. But the next step at this point would be to remove that press conference. It was introduced by Bernanke because Bernanke understood that if you could get the market to believe you, the market could do a lot of heavy lifting. The conditions had pushed the Fed to the zero line. And Bernanke thought, this is the most we can do right now is move to the zero line. We can buy some bonds to lower longer term yields, but we need the market on board. So that is why he offered a whole bunch of forward projections for where he was going, saying very clearly to the market, we're going to be here for a very, very long time. You guys go ahead and take risk. That was helping the Fed. And Powell continued with that. And at the beginning of the year, it helped the Fed because the market anticipated the rate lift-off and started lifting rates before the Fed, so the Fed could see how the market handled higher rates, and then they could simply just backfill all of the rate hikes that the market already put into the yield curve. So it was doing their job. But now, specifically, this idea of working on expectations for the market is a tool, is a monetary tool. It's the wrong tool to use now because the market will look past the end of your hiking cycle and start to price in rate decreases, thereby working against you. You need to cancel the press conference. You need to stop talking at this point because you got to take that particular tool, the market and the market's forward-looking expectations of where you're going to be next year, you got to take that tool and put it away. It's the wrong tool to use now. Wait until you're done raising rates and you got to lower rates because the economy is in recession and you feel you need to lower rates. Then you bring the market back in and say, okay, guys, we are going back down now. So you guys go ahead and do what you got to do. You guys go ahead and pile on risk right now because it will help us get there faster. But right now, if the market expects, if the Fed really says, we will really be done by the first quarter, we think it'll be over by the first quarter, we probably will be cutting rates sometime in July or August, maybe getting back to 2.5 if we're at 4, probably. But if we tell the market that, they'll do it now. And we need to go to 4 first. We need to get to 4. But if the market thinks that that's what we're going to do, even if it is what we're going to do, we can't have the market already pricing in what we got to do because we need to get to where we got to get to first. Cancel that press conference. All right, let's have a look at rates, housing. We'll look at PCE and second quarter GDP again. Okay, money market rates, capital market rates, all of them increased except the 30-year. Apt to call that unchanged. The 20-year unchanged as well, but all the way up to the 10-year we had increases in yields. New highs for the year, all the way out to, where are we here? All the way out to the 3-year. The big story still continues to be the curve inversion from the 2-year to the 10-year, 33 basis points. Last week was 27. Now we're at 33. It is being inverted now for 52 days. And as we've read from what Powell has said, that there will be some weakening in the economy, some loosening of labor market conditions. So recession expectations are rational at this point, then they're not going to respond to it. But negative 33, we've been inverted 52 days. Our next meeting for the Fed, 25 days away. And we'll look at the probabilities because they've changed as well. Fed balance sheet, week ending August 24th, has decreased another 1.57 billion. So that is 30.6 billion month to date. But I think on the 30th there are some maturing bonds. This is all from treasuries at this point. Nothing has come, a little tiny bit from MBS, but what they reduce on MBS gets added back because they already had some purchases scheduled. Same with September. There's a few purchases there, but big roll off in treasuries in September. For spreads, the only data available is up to the night before the Friday, so this is all I have for you. But all of them increased. This all should have been green. I guess I didn't turn the color green, but all of them increased on the spreads. I expect them to continue to widen as we go into the end of the year. Let's have a look at what happened to the probabilities. So here's last week. We had a 59%, or the market was pricing into the Fed funds futures, 59% probability of a 50 basis point hike and 41 for 75. That is basically flipped around. 39 on the 50, 61 on the 75. And what are we pricing in for year end as far as where we're going to end? 3.5, 3.75, or 4. The market was thinking before all of this that we were going to end at 3.5, hang out there for 3 months, and then come right home, come right back to the zero line. Now there's only 13.5% probability that we're ending at 3.5 based on pricing, based on market pricing. This is what they're pricing in. 44.4% probability at 37.5 and 41% at 4%. And I think 2 weeks ago on the market update, I said I think we end at 4. Only because the market is openly fighting the Fed at this point. The Fed's going to have to go further than they need to because of this. So the market, you got to blame the market for some of this, that they actually caused this to happen. Had they hung out around 3,900 on the S&P, 38, 39, and just kind of hung out there and held back a bit, you wouldn't have had this speech today, and you wouldn't have these kind of probabilities. But I think now you put them in a position where they have to come out and demonstrate very clearly that everybody needs to back off and let them finish. But look at that, now we're at 4%. We're now up at 41%. This was a non-existent probability a few weeks ago. Okay, our real rates, all positive, pretty much unchanged at the 20 and 30, much like they were on the nominal yields. Small increases at the 5, the 7, 10. If we took a measure of inflation against the 2-year, we would have negative real yields there. So if we're looking at the real yield curve from the 2 upward to the 5, it looks like this, because we have 47 basis points here. So the 2 to the 10 in terms of a real yield curve is still upward sloping. Break-even rates, you can pretty much call that all unchanged. I thought that they'd be a little bit lower based on what the Fed was saying, but he is sending the message that we're going to be higher for longer because he thinks inflation is going to be higher for longer, so no need to retreat on the break-even rates. Let's look at housing, because that's where rates hit first the hardest. National Association of Home Builders has already said our industry is in recession already. Even if the broad economy is or is not in recession, we clearly are. By a measure of recession, we are there. New home sales for July came in at a run rate, an annualized rate of 511, which is 12.6% drop month over month. Only the Northeast showed an increase in new home sales. But month over month, negative 12.65%. Year over year, negative 27.82%. Year over year, the South seems to be doing okay. Pending home sales month over month were down 1.32%. Year over year, negative 18.73%. Other than mortgage applications every now and then, I don't know that we've seen a positive number in the housing market for quite some time. If we look at the relationship between new home sales and new homes for sale, the blue in the background, the mountain graph over here is new home sales. You can see it pretty much coming off a cliff. You had a nice slow build over here, and then here's 2020. This was the pandemic surge, and then you're coming back down. Even if you extrapolate this out and say, okay, well, maybe this was too much, so it required a small correction down. It is well below where that growth trend was. And this is new homes for sale. We can see that, it kind of decreased here, but now it's increasing. Home builders are building more homes. More homes that were under construction are coming onto the market. So this is increasing. And if we extend this out, it kind of looks like all it's doing is getting back to a longer term run. It looks like it's fixing the pandemic dent that happened and getting to the underlying growth trend that existed before the pandemic, because this goes all the way back to 2014. So how we get months supply is you say, okay, well, if we're selling this many on an annualized basis and there are this many available, how many months at the current month's rate at this, not they don't take the last year, it's just this current month. If we take this month and we annualize it, how many months supply is available? And you can see it just going parabolic here. If you zoom all the way back to the mid-60s, here we are here. If you look at 12-month supply, it hasn't exceeded 12 months, even going back to the GFC when you had that massive overbuilding of housing. You can see it way up here. This is new home sales. Look at how high it got versus this peak over here was just at this level. This created a whole bunch of oversupply, and that's why you had this hollowing out down here for quite some time, because if you look how low new homes were here, it's the lowest it's been in a very long time. You had this is new homes for sale, almost no inventory down here because of the lack of building, and then we've just started building back up. But once you get to about 12 months supply, previously builders tend to back right off and say, okay, there's plenty on the market, there's no point putting any more on the market. So I think you'll see the supply of new homes coming onto the market pretty much slow down at this point. And all this is going to do, back here you had a surplus of houses. So if you had builders pulling back on adding more inventory, you still had a lot of inventory to clear out. We don't have that problem right now. You already have a shortage overall because the amount of new homes being added is lower than the amount of new family formation, about half the rate of new family formation. So even once this is over, you're going to have a shortage of houses and you're going to have elevated prices for a while. The housing problem that we had over here, 2007, 2008, 2009, is not going to happen this time. At that time, there was massive overbuilding and a lot of mortgage fraud going on, and no one was too concerned about the credit quality of the borrower. Not this time. We have seen reports about the housing market that just the last minutes of the Fed that we read, that the credit quality of the average borrower is much higher this time around, so you're not going to have that credit crisis. About 35% of all homes in the U.S. have no mortgage. All the other homes do have mortgage, ranging from almost paid off to somebody just took out a mortgage yesterday. But the average home in the U.S. has about 50 to 55% mortgage on the value of the house. But housing values have increased dramatically in the last 2 years, so there's a huge equity cushion out there that if prices fell 10%, it's not the same as prices falling 10% in 2007. That hurt a lot of people. This, a couple people here and there are going to get hurt with that. But overall, most people have more equity than that in their home, given the recent run-up in prices we had. So you're not going to get that big washout in the market that we had in 2007. One of the things that we'll see shortly is the amount of listings coming onto the market are actually decreasing. So people are choosing not to list their homes if they don't have to. So let me sort of give you a little story behind that. Let's say that you have a 3-bedroom, 1-bathroom house and you want to upgrade to a 4-bedroom, 2-bathroom house. You would list your house for sale and buy another house, and you'll get less for your house today, but you'll move into another house for less because listing prices are coming down. However, you'll pay off your 3% mortgage only to go into a 6% mortgage. So right now is not the time to sell, even if you need to upgrade. What you're going to do is head to Home Depot, buy everything you need, and install a second bathroom in the basement. So I think that now is an interesting time to start looking at that sector. Interesting because we have to look forward and think about a farmer. Actually, you know what? I'm going to wait and tell that story a little bit later on because it's important to something else I'm telling. Right now, here we are on new homes. Let's look at some more housing data. Okay, mortgage rates, 5.73 on the 30. It was 5.6 last week. We have a year-to-date high of 6.11 on the 30-year. The 30-year FHA mortgage, 5.12, was 5% last week. Mortgage applications, surprise, surprise, were negative, with the refis being down 2.76%, not shocking at all. Here's the refi index down here if you look at it over a long period of time where the refinancing activity happens. These are the highs of refinancing activity. These are all the lows. This is an interesting period of time right here, 1995. Look at how low the refinancing activity was there. There was all the indicators, 1994, ending 94, going into 95, was indicating another recession. We had just come out of the 1990 recession. You had the Gulf War at that time. Oil prices increased. And the economy never really got out of that recession very well and was lingering along. And the belief was that we were headed for another recession, and the housing market was showing it as well. But that was an example of a soft landing. So you had, in terms of business cycle, you had your late expansion, you had your slowdown, and it appeared, once you get your slowdown, the next phase you anticipate is your contraction. This was an engineered soft landing, and we actually did this. So, there are some people who believe that, well, no, we can engineer a soft landing at this point because the backdrop of the economy itself is very strong. We just need to get inflation out, and it's been showing signs of disappearing. We might just pull this off. So if you think we're going to pull this off, we're either going to do this or we're going to contract. It's one way or the other. so that in thinking about, because we always invest for the future and think about where we want to be, that makes it a little bit difficult. Do we want to be on this trajectory or this trajectory, right? So our refi index is very, very low at this point. Purchase index down 0.49, but here's the purchase index up here. If we draw a line straight back, we can see that the period of time, 2010 to about 2016, where the purchase index was lower. Keep coming back all the way here. Going in the late 90s, it was lower as well. And even though the refi activity was low down here, the purchase index still didn't drop as much as what the refinance index dropped by. Realtor.com, week over week, this is the week ending August 20th. Median listing price 14.4, last week was 13.3, so going back up. On a week over week basis, it's higher. New listings were 12% below last year. Week ending August 13th, we're 15% below. So it is still hanging down as being fewer listings than last week, but getting a little bit better because we're only 12% down. Active listings are 26% higher year over year. Last week they were 27% higher. The week before they were 28% higher. So we can see that, the active listings are dropping. Time on market, 4 days slower. Last week was 5 days slower. So this is actually 1 day faster than it was last week year over year. I will return to the housing market after I finish with GDP, PCE. We'll look at earnings the week ahead. We'll do all the usual stuff we do. And then at the last part of this video will be about a particular question somebody asked. And I thought, well, it makes a lot of sense to use that as the theme of what we can learn this week. So we'll spend some time on that topic, and then I will use a trade in the housing market I did as an example of what I mean by answering that question. Let's look at PCE, personal consumption expenditure. Our first line is personal income in current dollars. We can see July 0.2, and I added the other decimal places 1.6. You know my opinion about this idea of one decimal place. There's information in the second decimal place, especially when you have to take this number and annualize it. Just to see what that means on an annualized basis, that you're losing a lot of information by not putting that second digit in. I think that we should start a big petition and put a whole bunch of signatures on it to get these government offices to expand their data to 2 decimal places. How hard would that be? I have to believe you have a spreadsheet that generates this. There's one little arrow you click to extend the number of decimal places. Just click it. Just click it once. Just once. That's it. One more decimal place. That's not asking a lot here. Anyways, there you go. 2.642 for personal income, which is low, considering where inflation happens to be. Let's look at our price indexes down here. So PCE and PCE excluding food and energy. That is a significant drop on headline. It's actually negative 0.00066, but instead of saying 0, they brought it all the way down to a negative 0.1. They rounded that. See how much information is lost there? If you annualize this, you get to 0.8, actually a negative 0.8% on the year. But we're not too interested in food and energy because those pricing can go down and they can easily go right back up. So because they're so flexible, it doesn't really tell us the underlying trend. So let's get rid of it. You can see 0.3, 0.3, 0.4, 0.6, 0.1, lower than what we've seen before. It's actually 0.0845, not quite 0.1. So when you annualize 0.0845, you get a lower number than annualizing 0.1, 1.02. on an annualized basis. So if we take the 1 month observation and annualize it, kind of looks like job done, right? I think you would need to see almost 6 months of this before the Fed says, okay, we'll use that. It does appear to be out of the system. So we'll hang out here a little bit longer. Maybe we'll drop 25 basis points, but let's just see what happens. But I think you'd need at least 6 months for that to become a data point. So market-based PCE. This is and this is the market-based excluding food and energy. What does that mean when we say market-based? We've introduced it before. Some of the prices in getting to PCE are imputed prices. There's no market price for it, it's just imputed. Well, this is the PCE based on prices you can actually just see in the market, so all the imputed prices are gone. The big one being owner's equivalent rent. Month over month, 0.202. Annualized is 2.45. So it is double what we see here. Let's look at our price indexes for different categories. It gives it to us for durable goods, non-durable goods, and services. So the price index on durable goods month over month, and this is annualized. Month over month, negative 3.67. Annualized, negative 4.5%. Price declines on that one. Non-durable goods, negative 2.4%, but you still have price pressure here on services. I wouldn't call that pressure. You know, you want to be in and around 2%, 1.13. All of them are below 2%. What really is bringing down the goods, or the index is goods. Goods are showing a big drop, but they make up about low 20% of expenditure. The majority of expenditures are on services. Okay, second quarter GDP, our second look at it. One more word from the PCE on the previous screen. That is not a separate data point from the CPI. I think I've made that point. They're both looking at July. They're just two different ways of looking at what happened in terms of pricing. The CPI will give us the general price level, where PCE gives us the cost of living, because it measures what people actually buy, but it should not diverge. If the CPI showed a significant moderation in the price index or the price level, PCE will reflect that as well. So we can't look at that and say, but we have two data points. Well, no, we don't. We have 1 month. We have two different ways of looking at the same month, but PCE usually comes in below CPI. Nothing in that report would have contradicted what we saw in the CPI report. And nothing in that report was any new information that we didn't already know with CPI. That was what we saw was expected. But we have seen, since July, we have seen some prices go back up. Copper is a good example. WTI is higher. Heating oil, natural gas. Some of the grains are higher as well. Some of the other metals are higher. So, you know, those prices are so flexible that they can, you can't just take 1 month and say, aha, here we go. Especially if the lion's share of the price decreases have come from those flexible components, those headline components, whether it be food or energy, because they can go right back up, and they are. Okay, let's look at our second quarter GDP. Got upgraded from where it was before. It's not as negative as it used to be. Negative 0.6 on an annualized basis. That is taking the quarter and just annualizing the current quarter that you were in. We'll break it down in terms of consumption, investment, government spending, and the trade balance. 0.99 of the 0.6%, the consumer added 0.99. Goods took it down 0.57, services up 1.56. So if you net these out, you get the 0.99. Break goods down into durable and non-durable. We see the big hit came from non-durable goods. Investment, this is the big one, negative 2.67. This is growth, by the way. That is positive growth, negative 2.67. Fixed investment, negative 0.84. Well, that is consistent with higher interest rates. Usually fixed investment takes a hit. Inventory, negative 1.83. But we've already explained that thing in the inventory. We did have a build in inventories. There was a build in inventories in Q2. It's just that the build in inventories was far less than the build in inventories in Q1. So quarter over quarter, it showed negative growth, because the build was less than it was in Q1, which will help explain the difference between real GDP and real GDI down here, this negative thing. And if we annualize this, we're annualizing an outlier, which is, you know, the question, do we have a recession right now? All indicators show that the first 6 months of this year were not recessionary, even though GDP had 2 quarters of negative growth. It is because we're annualizing outliers. For going into Q3, we are expecting lower volatility in this particular category going into Q3 and Q4. That if you say, well, let's say that we get rid of this, well, that was almost 2% hit to growth, negative 1.83. If you correct the GDP number for that, you have a positive 1.2% growth. Government spending took away from growth as well. I have no problem with government spending taking away from growth. Negative 0.32, negative 0.25 at the Fed level, negative 0.06 at the state and local level, which is really nothing. It all happened here, and it all came in non-defense, negative 0.29. Defense spending edged out a small little increase. For the trade balance, exports up 1.88, imports not up. It contributed 1.88 towards growth. Imports took away 0.45. So what contributed to growth in the first half of the year? Consumption and exports. What took it down? Government spending a little bit, but really came from business investment, which is, of the 4 components, is the most volatile component. Typically, this is the most volatile component, but because of this shift in the pandemic to goods and then the shift away from goods back to services, that screwed up everybody's forecasts of inventories. That got really, really volatile, and it's showing up, but going forward, we're expecting lower volatility. So the idea of a forecast of positive GDP for the third quarter is not unrealistic if this component can settle down. Real GDP on an annualized basis, negative 0.6, but if you look at real gross domestic income, it was up 1.14. What gives? We learned in lesson 1, macroeconomics for CFA, that aggregate expenditure, which is our aggregate output, well, instead of writing it as Y, let me write it as aggregate output. Aggregate output, which is our GDP, equals aggregate expenditure equals aggregate income. We have this identity. So we can measure GDP in terms of adding up the sum total of all of the output produced within the economy, or just saying, listen, somebody's output is somebody else's income. Why not just add up all the incomes? They should be the same because it's an identity. So you add it up, you go, something's wrong here. Well, what's wrong is you're annualizing an outlier. Since you did have a build in inventory, people did get paid for building that inventory. You did have workers that created inventory, just less of a build than you had in Q1, which is why it's showing negative. So people still earned income, so you have this discrepancy. So an alternative calculation for GDP weights these equally, multiplies this by 0.5, multiplies this by 0.5. I call that discrepancy smoothing because we have a big discrepancy here, so let's just take an average of the two. You get 0.4. And if you do the same thing in Q1, you had 0.1 in Q1. So by taking a weighted average of the two, because they were different, real GDP was positive in the first quarter as well, 1.8, and real GDP for goods was a little more negative. Our GDP was a little more negative. So by taking the weighted average of the two in the first quarter, we had 0.1. This is an alternative measure of GDP. In the second quarter, you have 0.4. So when you realize, or when you sort of say, hey, you know what, we are taking this inventory anomaly and annualizing it, that's causing a lot of distortion. Perhaps a better measure, if this is an identity, perhaps a better measure is aggregate incomes. Perhaps. And so what they do instead is say, well, let's just take an average of the two. You didn't have negative GDP if you look at it that way. Q1 had positive growth annualized. Q2 had positive growth annualized. So by one measure, we had 2 quarters of negative GDP. But because we were annualizing an outlier, it's probably better to use the other measure of GDP, which actually showed growth in the second quarter over the first quarter. Okay, let's look at what is going on the economic calendar next week. Earnings season is pretty much over. Not much to look at there. We're not going to see anything significant there till October. So really the only thing ahead of us is the jobs report at the end of the week coming up. That's a big number. And one more CPI, which will be a pretty big number as well. And then the Fed meeting. And then after that, we're into earnings season for the third quarter. Lots of Fed speak this week. And I don't know that anyone is going to deviate from what Powell has said. I think he set the tone, and I think anybody speaking is going to toe the line. If you were watching the run-up to Powell's speech at 10, Bloomberg was interviewing a bunch of different central bankers, and the president of the Philly Fed came on, and I don't think he could have been more bullish if he tried. And as he was talking, I'm thinking, okay, you're saying that we're going to end the year this side of 3.5. He kept mentioning 3.4. That didn't seem realistic. And everything he was saying was supporting the narrative of a pivot. And I was thinking to myself, he must have a long-only portfolio. He must have a long-only portfolio because he is going out of his way to be as bullish as possible. And if you were watching the futures as he was speaking, they went up. We were basically at the flat line, and it was 12, 13 points on the futures. And I was thinking, what are you doing? Do you have some indication that Powell is going to be light in what he's saying? Should I be concerned? And I thought, well, let's just, if Powell comes out and sounds like this as well, then I got to think about covering my short positions and myself pivoting in my account, because then it's over if he comes out to support the narrative. But he didn't. But we got a lot of Fed speak this week. I don't think any of them are going to openly fight Powell on what they're going to say, so I think it'll be more reinforcement of the same. Let's look how much we got going on. Brainerd is on Monday. We have Barkin. They have housing price index, consumer confidence here. Williams later in the day. Next day you have Mester. You have ADP, the always wrong ADP. I don't know that I'd put any stock in ADP. Their correlation with the actual number is so low that, and it's been this way. I can remember going back 15 years, and everyone always referring it to as the always wrong ADP. So I don't even know why it's a thing, but it's a thing, I guess. For Canada, we have our second quarter GDP look, but we get the GDP monthly. So we already know what April, May, and June were monthly, so I don't think there's much of a surprise here that can happen. Bostic. What else do we have? We have some PMIs for the U.S. on Thursday. Another Bostic down here. And then the big day, which is non-farm payrolls. This will be closely watched. And I'm more interested in the participation rate because you can have a situation where unemployment doesn't move, but the participation rate keeps dropping and dropping. And that will continue keeping wage pressure going up, which means the Fed's going to have to be higher for longer, because that becomes part of the pricing of everything. If companies have to pay more for employees, they start raising their prices. So unless the participation rate starts going back up, 62.1, 62.2, 62.3, you're not going to fix this problem in the labor market. Now you can with automation, but that takes time to get done. I don't know that this is going to turn around. I think that we are in for probably a long period of time where the participation moderates downwards. So I think that you're going to have a shrinking participation rate over time, which is going to create a bit of a problem. Is how do you solve that particular problem? You would have to accept a much higher level of unemployment to put slack in the labor market. And if workers are disappearing from the labor force, well, how much unemployment, how bad do you have to make a recession to get unemployment if people leaving the labor force are shrinking the supply just as fast as you're trying to increase it by putting people out of work? So this participation rate, in my estimation, is probably the far more important number right here. But, I mean, you could have negative growth in jobs. You could see the unemployment rate tick up without the participation rate dropping. Maybe you can create unemployed people faster than other people are leaving the economy. Maybe you can get that done. And then factory orders, I don't think is going to mean very much after we see the jobs report. This is the one that the Fed is going to look at. So you got a lot of Fed speak during the week, ending with a big report. Okay, this was a question that appeared on, I think it was either Friday or Saturday under last week's market update video. And I was going to address it on Wednesday, and I thought it's actually probably a good time to put it in the market update because not everybody watches the Q&A video that comes out on Wednesday. So I thought I'd put it in this one because it is a common reaction to uncertainty. Let's see how we deal with this. Hi, Mark. I guess you performed very well with the shorts this week. How do you manage the patience? It's a good question. I had short calls until the 4:30 rally, then sold my calls. Well, if you had short calls, I think you mean then covered your calls, but I know what you mean. Covered my calls thinking we were going to rally even more, and then the market had a 5% down movement, and I just had the shares without any protection, so I guess double loss. Yeah, which you sold calls, the market went up. You took your loss on the calls, the market went down, and you lost on the underlying going back down. Closing calls at a loss and losing on the shares. Were you ever going to close the calls if the market would have rallied to say 450? Good question. I guess the answer is only sell calls with covered shares. Nope, that is not the answer. Never naked calls. Always wiser after the mistake, I guess. And I think this is worth exploring, this idea of patience. If you feel no sense of urgency, you can have all the patience in the world. When you have a single position, and that single position is working against you every single day, you have a sense of urgency. You don't have the luxury of saying, I'm okay, I can wait, because you're feeling it every single day. So the goal is to put yourself in a position where you don't feel a sense of urgency, but still being invested. So let's contrast the different ways that institutions versus retailers look at the market. An institutional asset manager manages risk at the portfolio level. Profit and loss is an outcome of that. That is their job, is to manage risk at the portfolio level. And if they see market weakness ahead, then they want to manage their exposure to that risk factor. That does not mean, get out altogether. It means take on other positions that could lower their risk to that particular factor, but staying invested. That could include a derivatives overlay where, I have a beta of 1.3 going into this. I see some weakness. Let me reduce my beta down to 1.1 or 1, and you could use a derivatives overlay to get that done. You're not getting out, you're just reducing your risk exposure. Retail investors look at it a different way. Rather than managing risk at the portfolio level and letting profit and loss be an outcome, they manage the outcome. They manage profit and loss at the position level. I say most, not all, because there are some sophisticated retail investors out there, but for the most part, they'll manage their profit and loss at the position level. So when you talk to retail investors, you hear things like, well, I'm down on this position, I'm up on these two, but I'm down on these three. When you talk to institutional managers, they'll talk about the level of risk that they currently have. I got my portfolio to, my volatility's down to this, my duration exposure's down to this, my beta's over here, my value at risk, I've really dropped that down, my expected shortfall is low, all in terms of risk. Whereas the retail investor talks about what positions are in the money, what positions are not in the money, and risk is either ignored at worst or not well understood at best. So it's just an opposite way of managing assets. Institutional asset managers, risk first, the returns will be what the returns will be. There's not a lot you can do. If the market's going to go up 10%, it's going to go up 10%. The question is, how much exposure do I want to the market? That's managing your risk. Individuals, tend to buy individual names, oftentimes not really appreciating that a lot of those names pretty much come from the same sector, usually the IT sector. It is the most volatile of the 11 sectors of the economy. And they're looking at my profit and loss per position, and rather than looking at their risk at the portfolio level. And if you manage your risk at the portfolio level, you would find that you're managing one thing, not 15 positions, but one thing. And you can always ride out a rough patch by simply just managing that aggregate number. So let me see if I can show you how that is done. Okay, the portfolio level statistic that I look at is dollar delta beta. It is one statistic for the entire portfolio, and every position I have a dollar delta beta. But if I'm trying to manage risk, I'll do it at the portfolio level, which means I'm not looking at position by position and saying, well, this one is making me money, this one I'm losing money on. I look at the portfolio as a whole and I decide what kind of exposure I want. Do I want to have neutral exposure, positive exposure, or net negative exposure? I should say net long or net short exposure. I'll go into this a little bit more detail on the next screen. Your trading whatever you're using, your trading platform should offer you this portfolio level statistic. I don't know what feature it would be in yours, but I'll show you where it is in Interactive Brokers. We're using this because this controls for positions of different size, different direction, and different market risk. And if we look at a stylized business cycle here, we have late expansion, the slowdown, the contraction, initial recovery, late recovery, early expansion. If you keep your eye on your top level risk statistic, this is the amount of risk you're willing to take. This is the level of risk. At certain times, you want to really load up on risk, down here. At other times, you want to lighten up on risk, maybe get neutral. Way over here, you want to start thinking about getting neutral. And over here, you would like to be positioned net short. Not 100% short, because you could have this slow down and then off you go. You want to be net short so you don't get too hurt. When we talk about diversification as well, especially in periods like this, we're probably right about here in the business cycle. And when we talk about diversification, there are a number of ways we can think about that. There's diversification across the sectors, there's diversification across companies, but there's also diversification across the phases of the business cycle, diversification across time. I'll show you how I do that in mine. But as we're going, as the economy is improving, we're looking at our leading indicators, our coincident indicators, our lagging indicators should help us triangulate where we are. As you're getting into the late expansion, you want to start lowering your dollar delta beta. Now from here on in, I'm just going to refer to it as DDB, because dollar delta beta can be a tongue twister sometimes. So I'm just going to call it DDB for short. You want to start lowering that because over here you were net long. You want to start lowering that long position. As it becomes clear we're entering the slowdown phase, which usually lasts 1 to 2 quarters. Slowdowns are not multi-year events. They're usually 1 to 2 quarters. You want to get neutral to net short. Now, if we do take off, that's why I say neutral to net short. It depends on how convicted you are about which path we're going. If you're neutral, you're not going to get hurt, which means if your short positions work against you, well, your long positions are working for you. You don't have that sense of urgency because you're managing a portfolio level statistic and you're not paying attention to all those individual positions. You're just looking at your portfolio level. You're saying, I'm not making money, but I'm not losing money. I'm kind of going sideways, but that's the cost of being risk neutral at this point, is that I'm going to give up any gains, but I'm protected from any losses because I do not know what's going to happen. As you move into a contraction, contractions usually last 2 to 4 quarters. This is where you want to start adding some short delta now, or some short DDB. You may have some positions that you never get rid of because they provide the income stream in your portfolio, or they're very good income factories. An income factory is an ETF or a stock that has business cycle exposure. I mean, it'll go up in good times, it'll go down in bad times, but it has much lower volatility than the market, but liquid options. So you can use that to generate income on a consistent basis. So you may keep your income factories. Here you're net short. Not 100% short, and as the contraction, again, 2 to 4 quarters, don't get married to it. You know, once you do 2 or 3 option cycles, you might want to start thinking about, well, let me start thinking about a change in focus, because you know, when you say 2 to 4 quarters, you're 6 to 12 months. So you know, once you get through 3 option cycles, if you're doing it every 45 days, you're enough into the contraction that you have to start looking at, well, the market's going to start anticipating something. Should I start raising your DDB because you're net short? So we were positive, we went to neutral, we went to negative. We want to start raising it back to neutral. When you are seeing that the contraction is probably going to end soon, and you're starting to see little green shoots in the economy, the initial recovery is ahead. When you're raising your DDB, you couldn't do that by seeding the next phase of the business cycle, starting to look for toehold positions for the initial recovery, or by closing your short positions. Here, at this point, you'd want to be net long. Again, you're managing just an overall portfolio statistic. And then as it becomes clear that we are past the problem and that the recovery is well underway, this is a multi-year phase. I wouldn't really commit very long until I see the Fed lowering rates. Once they start lowering rates, don't fight the Fed, then you can lean into that. So that sounds kind of neat, but let's actually see it in practice. Okay, so we'll just do a little quick tutorial here on the statistic, the DDB statistic, and then I'll show you the S&P over the last year. And if you have been following every week, you know that there are times where I say, I'm going to do this, I'm going to do that. Well, I'm going to show you where I did that and why I was doing that. So for your DDB, you have to set a beta. Because dollar is easy to look at, it's the price. Delta is easy to look at. For stocks, each share has a delta of 1. Options can range from -1 to +1 depending on if they're in the money or out of the money. And again, for dollars, it's just price. But beta, we do have to set beta. If you are in a Risk Navigator and IB, you can set your beta calculation method. When you first open it up, here's the default. The default is 2 years daily, which is probably a good look-back period, is the most recent past, and you're doing it daily. You may say a better look-back period for you. You can change the custom horizon. You can say, well, I don't want it from the last 5 years. I think the next couple of years are going to look like this period of time, 2012 to 2016. Maybe you want it for that interval, but you can choose the look-back period for your beta calculation, whether it's daily, weekly, or monthly. So you can set it where you would like. In calculating this statistic for stocks, it's just the price of the stock times the number of shares you have times the beta of those particular shares. So you may have shares that have a beta of 2.4. Then you may have other shares that have a beta of 0.8. So you can't just say, but I'm 10,000 long and 10,000 short. I should be neutral. Well, no, you're not, because you're not beta neutral at that point. You may be dollar neutral, but you're not beta neutral. For options, it's the price times 100, because each contract is for 100, times the delta times the beta, and it's the beta of the underlying that the option takes. And it'll give you this for each name that you have, and add up all the names to give you this at the portfolio level. So let's take the example that we had earlier, where somebody had sold calls on the SPY. SPY short calls, and let's say they sold calls at 400. SPY is at 430. The dollar delta beta of that would be 430 multiplied by the beta. The beta of these options would have been about 0.9, being that much from 400 to 430, times 100 shares, and since it's on SPY, it has a beta of 1. We have negative 38.7. Here are your options. You can cover, which means you take a loss, and that brings your dollar delta beta on that position to 0, or you can add dollar delta beta from somewhere else, which is a hedge, and you can get to the same position, 0. So closing your position and bringing this statistic to 0 is the same as adding a position with a positive value and bringing the position to 0. You still bring the position to 0. And it allows you to stay in the position. Now you've added something else, and this something else you added should be for what you think is going to happen. And if you still want to keep your short position, you think, well, I think we're going to enter into a contraction. What's going to do well in a contraction? Your first stop should be XLP, which is staples. Beautiful thing to be in a contraction because it holds its value. So you might say, well, let me add some dollar delta beta with staples. And here's what's going to happen. If the market rallies, this will go up too. If the market sells off, this holds its value and my short positions pay off. There, I can stay in my trade now because rather than closing my trade, which is a trade, I've made a trade which allows me to stay in my position. You achieve the same outcome. Now you have patience because some positions simply just take time to work. Just because you take a position doesn't mean the market's going to work in your favor. What you would like is the ability to take your position when the time is right without having to worry about, but I need to be in gains. I'm in losses. If my losses continue, I got to stop. Well, then you've done it wrong. You have to look at your risk at the portfolio level. Now, I'm going to introduce a story here about a farmer and his field and how a farmer takes care of things, how a farmer operates. There are 3 seasons for the farmer. There's the planting season, or what is called the seeding season. There is the growth season, and there is the harvest season. So at the beginning of the year, the farmer has to make a decision about what fields to seed and when to seed. If the farmer doesn't seed in time, you have a terrible growth season, which means there's going to be no harvest. So you got to get your seed in the field by a certain date. After spring, and that'll depend on what kind of spring you had. Are your fields still flooded? If they are, after the snow melt, well, you're not getting your seed in. You got to get it in before mid-May or the end of May. Otherwise, you're not going to catch that growing season in July and August to have your September harvest. So the farmer decides to seed the field based on their expectations of what's going to happen. Where do I think soy prices are going to be? Where do I think wheat's going to be? Where do I think corn is going to be? Because the farmer has a choice about what to seed. Can also look at fertilizer prices and say, well, where do I think fertilizer prices are going to be? If they're going to be extraordinarily high, maybe I'll plant soy because it returns nitrogen to the soil. So there's a lot of thinking about what's going to happen for the seed phase. It's the same thing with stocks. When you are taking on new positions, you're seeding the growth phase. That's what you're doing, seeding the growth phase and then having the patience to wait for the growth phase to harvest. The farmer doesn't plant seeds and then run out there the next day and say, okay, are they ready? Are they ready? No, they're not. They understands that there is a growth period and a whole bunch of risks can come into this growth period. Too much rain, not enough rain, too much sun, not enough sun, rain at the wrong time of the season, rain too early, rain too late. There's a lot of risk management that happens during the growth season, all with an eye towards harvest. So when you are taking your losses, you are basically harvesting that loss right then and there, when you could have said, well, hang on, this is still in the growth phase. It's just there's risk in the growth phase. Why don't I offset the risk in the growth phase by seeding another field? And what I'm adding here will offset what I have here. Now I have the patience to wait through the growth phase. And when the time is right, I will harvest this. And by harvesting this, I will then have this net long position instead of a neutral position. So I'm diversifying over the phases of the business cycle by looking ahead. I'm going to show you how I did that in the last couple of months. And you can always go back over my weekly updates and review them to see I did exactly what I said I'm doing on the next screen. I'm not just making it up. I did those things. and then I'll show you what I'm doing now as of the end of Friday. Late in the day on Friday, I made a few trades. I was actually doing a live AM session for level 3, and I had to keep saying, I said a couple of times, just give me a second here, I got to make a trade. And I had to excuse myself for a couple of minutes just to make sure that the trades that I had already scheduled were still in play, and that I didn't need to do any kind of jumping around. I'll show you that trade I did, because I don't want to cover my short position when the market sold off that day. I want to keep that short position because I think there's more to come. I don't want to be shaken out, but what if I'm wrong? What if the market rallies? Well, let's reduce my net short position towards zero, but not by covering my short positions, but by introducing some other position that I would want anyways. Okay, this is messy. I know it's messy. What are we looking at here? This is SPY. This is the last 6 months of SPY. There's that big sell-off. Here's the June lows down here. And if you go back through my weekly updates, all of these things that I've written down as the index was bouncing up against 39, you'll note that I had mentioned all of these things along the way. So it's not as if I'm cherry picking and adding things now. I want that to be clear, so that, because sometimes, there are people who do this kind of stuff on YouTube and they say, I did this over the last week and I made this much, and you never heard that they did it. They just tell you after the fact that they did it, and it's all designed just for your consumption. Look at this Friday. That is the last day. That is that big sell-off. Pretty ugly, right? I don't think the sell-off is over. I think it continues on. One of the reasons I don't think it's over is because over the weekend, Bitcoin, it doesn't stop trading. The futures don't stop trading. It was all negative on the weekend. So there's still negative sentiment in that space. If it turned green and it was positive, I'd say, well, risk is back because money is flowing into that. But it was negative. So I think that we will probably still continue with the sell-off into Monday. How long? I don't know. With these markets, I just don't know. I don't know if the market is going to think about it over the weekend and start chanting, "We don't believe you," and come out on Monday and throw a punch back at the Fed. I don't know if that's going to happen or not. So anyways, we had this big sell-off down here, and as it was selling off, I was adding, you have to do the opposite of what the market is doing. If it's selling off, prices are lower. Prices are lower, well then let's add some risk. I was adding dollar delta beta. And I had put a video out, this was near the end of June when I put this out. I said I had sold puts on PIC, on BHP, and on Rio. PIC and Rio expired in August. BHP expires in September. And this one finished in the money, made all the money on that. Rio was put to me at 60. My average price is 56.30, but it's now 59.71, and I have my initial position in Rio Tinto that I wanted. This is me seeding the future. I think that this sector, given the big global move to new energy, is going to require a lot of inputs from materials. So I want exposure to that sector. So I am seeding the future by getting some long positions in DDB. Now, if the market rallies, well, this goes along for the ride. If the market continues to sell off, I've started to seed this position. I haven't taken a full position, just seeding that position. As the market rallied up to 3,900, I was selling calls on the index. I sold calls on the index all the way up. I sold at 390, I sold at 400, I sold at 405, and I sold at 415. On the way up, I sold calls on the index all the way up. I kept adding negative dollar delta beta. As it was going up, I added more. So that by the time the market was up here, I was negative dollar delta beta on the entire portfolio. But not 100% short. I had short positions and long positions, but I was net short. Net short to the point that if the market was going up, yeah, I was probably showing losses, day over day losses, but not significant. As time went on, I sold more puts. I remember this in the video telling you I sold puts on Disney, Nike, Cat, FCX, JP Morgan. By the way, they all expired. They all paid off. All of them paid off nicely. So then we had this breakout, and when we had this breakout, I just didn't like the pricing anymore. So I wasn't adding to any long position at this point. As we were going up, I wasn't convinced that it was correct. And this is the thing, right? This is what you need to come with. You need to come with knowledge, experience, discipline, and patience. Knowledge you get from education, but that doesn't mean you know what you're doing. It means you have a good foundation on which to build your experience. But you need experience, and experience only comes with time. It's not something you can throw on your resume. It's something that happens over a period of time. So you don't graduate with experience, you graduate school with education. Now you got to go get experience. Discipline means you have a process and you stick with your process. That you're not chasing performance, but you have your goal is not to make money. Your goal is to work your plan. Making money is the outcome. Your goal is the process. And then that gives you patience. If you're good at this and you watch your high-level statistic, you have the ability to stay in a trade because, yeah, this one's losing, but all these other ones I added are winning. That's the same as if I went back in time, didn't add these, and just simply removed the short position. It's the same thing. So I call this the seed stage. I'm just seeding what I think is going to happen in the future. And the market keeps going up. I didn't get shaken out. I just kept adding on the way up until I got to a point where I said, okay, I'm net short enough. I'm in a holding pattern now. And I think it was 2 weeks ago or last week where I said, I'm basically in a holding pattern. I'm not adding and I'm not subtracting. I'm just sitting here because I'm comfortable. At the very top, I did sell in the money calls on my GM position because I just wasn't feeling it anymore, so I sold it. I did that on a Thursday. The day before options expiration, I sold in the money calls. Rather than selling my position, I sold in the money calls to get it done because there was still some time value. It gives me some extra money above where the market price is. And you know what happens the next morning? GM comes out and says, hey, let's increase our share buyback and reintroduce our dividend. And they did it on options expiration day. That was planned. That was shitty pool. That was planned. That upset me. Anyways, I could have done better had I not done it, but I didn't know that that was going to happen. And I really wanted to introduce that exposure. That put a whole bunch of US dollars in my account. So I did add a hedge. That's not fedge, that's plus hedge. I did add a hedge on my US exposure at this point. This lowered my positive delta beta, which then really made me net short. And I was comfortable being net short at that point because I thought every Fed official is saying back off. And the market just doesn't believe them. This is not going to end badly. Think about it this way. The Fed is the biker gang. And everyone else is just the nerd. And the nerds went to the biker bar, went into the biker bar and started bumping chests with the bikers. You know, going up to Powell, you talking trash about 4% of my girl? Outside, buddy boy. Well, that wasn't going to end well. And it didn't end well. So, you know, I was comfortable maintaining my short position because I had the experience behind me to say, this doesn't feel right. This doesn't feel right at all. And I stuck with my process, which allowed me to have the patience. And, you know, the market started selling off. I really didn't do anything. And then we had this rally, which is frustrating when you see that because you think, okay, here we go again. And then we got it. In fact, you know what was frustrating about this day? Powell was speaking and the futures were doing this. Then he finished, said goodbye, and the futures did this. And it was at this point that I felt like destroying some things because it was, come on, what more can be done? You've got to be kidding me. You got a bloody nose. The guy's walking back into the bar and you're going to start calling him names again? You've got to be kidding me. And then that's when we had this and I said, that is rational. So because I was net short, I was doing well that day. And as the market continued to drop, that's when I said, okay, now let's cover some of our short positions. So I covered the 415 calls and made some money on that. I still have the 405s, the 400s, and the 390s. And one of the set of options I had got assigned to me in August, so I actually have negative shares. I actually have a short position in shares, which I plan to hold. So I lowered my negative position, which brings, if we think that this is the zero line, I was net negative, so that brings me closer to the neutral line. This is neutral on dollar delta beta. This would be positive. This is negative. So it brought me a little bit closer. But I don't want to close the rest of my short positions. Well, what if the market rallies on Monday? You know, you would have wished that you would have closed your short positions. But if you close your short positions, what if the market sells off 10% next week? Well, then you wish you wouldn't. I want to stay in the trade because I think I'm in the growth season for my shorts. I don't want to harvest them yet. However, I do want to do some risk management, so I started adding new dollar delta beta in another sector, and I'm looking forward to the next phase of the business cycle saying, well, if we're in the slowdown and we're heading to a contraction, where do I want to be? And you start seeding where you want to be, and that is adding risk. You have negative risk. You want to add risk to get to zero. It doesn't matter where you add your risk from. You can add your risk by closing your position, which, well, now you've harvested early. You're not in the game anymore. Or you can add it by seeding the next phase of the business cycle, which I've done. So I moved, on this day, I moved closer to neutral from negative by seeding the next phase of the cycle. So I used covered short straddles to get this done. And I'll explain why I used covered short straddles to get that done, because it's a great way of generating either a nice quick return or a lower price on building your position. So let's see some of the things I did. Okay, and this is going to seem very counterintuitive to you, is why would you do something like this? But this is XHB. This is the home builders. I put on a $62 short straddle for a 1/4 position. And why am I doing something like this? Because you got to look ahead. I'm looking at the month's inventory approaching 12 months inventory. I look at the conditions in the housing market, and we still have a very short supply. So where do I want to be in the next bull run of the market? I want to have exposure to the housing sector. I want to have exposure to the home builders. And since I want to stay in the trade that I'm in, I need to add something now. You'll notice that as the market rallied, so did the home builders. The home builders rallied. As the market sold off, so did the home builders. There's a positive correlation between them, which means next, on Monday, if the market decides that it doesn't believe the Fed and it wants to rally 200 points, the home builders will come along. So I'm good. I can stay in my short position if I add some positive DDB. And I don't want to add positive DDB of where we are now, because what if I get it wrong? I want to add it to where I think we're going. Now, the farmer knows that there's going to be a growth season. Doesn't know what it's going to be like, doesn't know when it's going to start, doesn't know how long it's going to last, what the conditions are, but knows after the seed season comes the growth season. After growth comes harvest. Well, after a slowdown typically comes a contraction. And based on where we are with the Fed raising rates, I don't see a soft landing going on. It has never, ever, ever happened when inflation is this high and unemployment is this low. There has never, ever been a soft landing. I play the odds. This is the best you can do on repeated trials, is to play the odds. I'm playing the odds. This sector is already in recession. So this sector is something where I think, okay, well, a lot of damage has been done already. I'm willing to step in, but just a toe hold position. And not because I want to get this exposure now because I think this sector is going to explode, but because I want to manage my high level portfolio risk. I want to add dollar delta beta. So here's how this trade is structured. It's a 62 short straddle, so I'm long HXB at 62.01, and I immediately combine that with a 62 put and a 62 call. I'm short the put, short the call. This will have a combined delta equal to 0, and I'll get the full delta on XHB. So this is kind of just like a free overlay on this one. 391 on the combination of the put and the call. And here's the outcome. Something's going to happen because these are 62s and the price is 62. Unless the price finishes in September at exactly 62, I'm either going to be called or put. one of the two. So let's say I get called at 62. That's a 6.3% return. So if the market rallies next week, this goes along for the ride, and I'm going to get, in the next 21 days, a 6.3% return on this one single position. Is the market going to rally 6% from where we are? Well, 6% to 4,000 is 240 points. That's a 6% rally on the market. Will HXB rally by 6%? No, it'll lag the market, but it will go up. I just locked in 6.3. Anything over 62.01 in the next 21 days, well, I'm going to hold it right through to expiration. On 21 days on expiration, if it's over 62, it gets called away. I immediately make 6.3% because I'll get paid 62, which is what I paid, and I get to keep all this. Well, what if it finishes below 62? Well, then I get to add the next quarter of my position at a price 6.3% lower. Well, if the market drops another 6.3%, that takes it to 37.60 by September 21. I don't think we'll put in new lows, but I think the right place for the market right now, I think the right place is somewhere in the 38 to 3,900 range. I think 39 was the high price of what I thought was fair market value given the conditions we're in. I think we're going to go back into that range. I'm not looking for new lows. That might happen, but that's not my base case. My base case is that we return to something a little more reasonable, somewhere in the 38 to 3,900 range. 6.43% drop on the SPY puts it at 37.60. I really don't see that. So if I waited for another 6.3% drop in HXB before I bought it, I may not get it. So I'll take what I have now. If the puts are put to me, my effective purchase price is 58.10 because I got 391. My average price will be 60.05, not 62.01, which is some 4% lower than where I paid right now. And I would have half my position, and then I would do another short straddle for the next quarter position. Probably maybe 2 months out to get a nice premium on that. And then I do the final one maybe another 2 months out. So that puts me somewhere in the first quarter of 2023 that I will have a full position in this. Pays a dividend. It has options. So what do I have in the interim? I have an income factory. I have, if this sector is still under pressure, I can continue to sell calls on my position to equal the dividend. I'll get the dividend. I'll sell the calls, I'll double the dividend, I've got myself a nice income factory, and now I have a long position in the field that I want to be in. I've seeded my field. Now I just have to wait for the growing season. And this growing season I think will be a multi-year growing season, and then I'll harvest at some point in the future. So I added that. I also added a few other short straddles on sector levels. I did it on XLE. I did a short straddle on XLE because I don't think that the energy story is going to go away with the fall coming up. And while energy is driven by GDP growth, we do have positive GDP growth at this point. We haven't got negative GDP growth yet, but we do have an underinvestment in CapEx in the energy sector altogether. We have a massive build out to go over to electrify the world. Well, there aren't electric vehicles and electric energy to electrify the world. You have to actually use carbon-based fuels to electrify the world because you got to get all that done. So I think that energy is going to be well supported for quite some time, only because inventory levels are so low. I'm looking ahead. So I'm seeding that by selling covered straddles on that one, well, short straddles, I should say, a covered short straddle. This allows me to keep my short position. I've also done it on XLP. You want an excellent income factory. There's XLP. Excellent income factory, by the way. I can't even tell you how beautiful this is for generating income. Just absolutely beautiful. And when the market goes up, this goes up. When the market goes down, this goes sideways or slightly down. It outperforms the market in conditions like this. It is a beautiful, beautiful place to be. There are two other sectors that have the same quality as XLP that are just beautiful places to be. So if we sell off, guess what? My short positions on the SPY Chick-ching, 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 and I will harvest somewhere around mid 3850, 3900. I'll start to harvest that particular field while adding more positive dollar delta beta at that time. If we rally up, well, I'm not going to cover my short position, but this will come along for the ride and allows me to stay in my short position longer because I don't think we're done. All right, to show you an example of seeding, I had put this strategy on for D.R. Horton, a home builder. I did the 60-90 November short strangle, which means I sold the 60 put, sold the 90 call, because above 90, I just don't see the price getting there, because we are going to have higher rates, and there are still supply issues of getting housing to market. And with inventory, months of inventory building, home builders do slow down. So I don't see us getting above 90. 60 is the low of the year, and we do have low inventory, so I would want to get a foothold in the housing sector, and I like this builder. So when I did the short strangle, I got 415. It is now 259, even after all of this volatility in this last week. This position is paying off because I am selling this part of the distribution and this part of the distribution. I don't care what happens in the middle. My break-even points are 94.15, 55.85. So per contract, this trade is up 156 per contract. Margin, if you're non-US, your margin is 939. If you're US, your margin was 500. So you would have had to have posted a $500 margin to get this done if you were in the US, and you are up 156 on that investment of 500. These expire in November. You could easily take profit on this now or let it run. Because I am indifferent, I don't mind them being assigned to me. I'm simply going to keep them. So you could be looking at a particular sector and say, why would I ever want to be in that sector? There are no bad stocks. So if we look at home builders, there are no bad stocks. There are only bad prices. At $72, is that a good price? Probably not for where we are and where we're headed. But is $60 a good price? Yeah, I'd be a buyer at 60. Well, then say so. Make money by saying so. Okay, fine. I'll put my money down on the $60 line. If it got to 60, I'll buy it. If it doesn't get to 60, I make money. And I can roll that over for as long as I want. Now, when it gets put to me, that's fine. It pays a dividend. It clearly has options that are liquid with good premium in there. Look at its implied volatility sitting around 40%. There's another income factory. And that is my growth season. And I let that grow, and I'll harvest it when I need to. So just to kind of give you a different way of looking at your position. If you have a position, a short position right now, or you had a short position, or whatever position you have, and it is showing losses, rather than look at the loss that you have, look at the risk exposure you have by calculating what your dollar delta beta is. And you have two choices. You can cover your short position to get to zero, or you can add positive dollar delta beta to get to zero. What you'd like to get to is risk neutral, such that when the market moves, it doesn't hurt you. And when it doesn't hurt you, you can wait to harvest this position because you've seeded this position for where you think you are going to head. In the applied series in the options course, I there's one video that follows ChargePoint, CHPT, which I sold puts on. I sold $19 puts and I sold $18 puts. And in the video, I'm telling you specifically that I have a very low conviction for that. They are going to get put to me, but I wanted to get in trouble on a position to show you how to use options to get out of trouble. So at one point, this position was quite negative because they did get put to me, and so my average price would have been $18.50 less. I guess I got about $1 for them. I think if I'm trying to recall right, my average after premium cost was $17.50. This went all the way down to $12, and it was for 2,000 shares. So the underlying was handing significant losses. So I was showing how to use options to work your way out of a loss. And somebody said, why not just take your loss and move on? You know, all of this work just to get back to zero. Why not just take your losses and move on? taking a loss of $5,000 on something and moving on is the same as taking your $5,000 loss and getting it back to zero. If you take your loss of $5,000 and you go somewhere and you start at zero and try to earn $5,000, it's the same as starting from negative $5,000 and working your way to zero. Because you have the options and they're liquid, you can work your way out of a position over time. That's the process. And if you have patience, if you have a process in place and you work the process, you find that it gives you the patience to stay in the trade long enough. This over a 90-day period, from the time that I sold this to the time that I was out, over a 90-day period, I walked away with a $4,200 gain on this trade, as opposed to taking what would have been a loss otherwise had I just said, oh, well, I'm underwater on this position, let me get out. At the portfolio level, I was fine because I was managing risk at the level of the portfolio, so this position I could stay in. And if you know how to roll your options as the price changes, you can work your way out of trouble. So I guess my short answer for the question that was posed earlier, which is a very, very common question with retail traders, is how do you stay in the trade? Because I'll tell you, it's probably very common. And many of you will probably be shaking your head, yeah, that happened to me. It's probably very common that by the time you lose patience with a trade and you close the trade because it's causing you too much pain, it's pretty much the time where that trade would have started working. And you feel that, oh, come on, man, the market was just waiting for me to get out. It's a conspiracy, and you feel like the market's against you because you gave up right when you shouldn't have given up. Had you just waited one more day, it would have been different. How you stay in the trade is you find other trades that allow you to stay in that trade. You don't always think of binary decision. I'm in or I'm out. You have to look at it as a portfolio. Your portfolio is there to make money. And in making money, you're going to take positions, and not every position will work out. But if you manage your portfolio and not your positions, you'll do a lot better. That is the whole basis, by the way, of the Applied series, is it teaches you how to do this. It gives you the education along with the benefit of as much experience that I possibly have. And what you have to take away from that is what works for you, and you have to figure out, okay, well, what's the process that I'm going to follow? And if you stick with your rules and you stick with your process, you will have patience, and over time, you'll gain experience without it being super, super expensive to gain that experience. And with that, we'll leave it here. We have a very exciting week ahead. What's going to happen? I really don't know. It is 2:17 p.m. on a Sunday. The futures don't open till 6 p.m. tonight, so I have no visibility on what's going on. 3 hours and 45 minutes away. And we'll see what futures look like. We'll see what the week looks like. I can't see a recovery rally from what we had Friday because we sold off into the close. That usually spills over. So I think that we have a little bit more, but I don't think that we have 3,600 ahead. I don't think. That doesn't mean I'm right. It just means that based on what I can see right now, given the strength of the economy, given the strength of earnings, but given a Fed that has bloodied our noses, I think it makes a lot of sense to keep our mouth shut for a while and, get away from the biker bar, which means 38 to 3,900. Let's see what happens.